1 minute. Okay, we are live, and my little cluster of followers are here. In case you're watching this on video live from Tibet or Kenya, this is what the class looks like. There's not very many people there. There's actually 60 people in this class, but we have a low attendance rate. Only the true followers are here in person. So, okay, so the GDP numbers were released this morning as we anticipated, and we built those into the lecture, so now we can kind of get back on track and be using data that's very current, not even 24 hours old yet, so that you not be confused. Let's take a look momentarily at the lecture slide page. And so the way the lectures are arranged on that page, other than the introductory lecture, we have the lecture we gave about a week ago or so that started with the pathology of the business cycle, and that normally would have been the third lecture given. But we wanted to wait on the lecture to be given today called Introduction to the National Income and Product Accounts, so we could use really current 2019 data. So the lectures are arranged in the following way. Lecture 1A, the pathology of the business cycle, which was supposed to be lecture 2. Then lecture 2, you're hearing today, which is Introduction to the National Income and Product Accounts. And then lecture 1B is Data in the Business Cycle. As you'll see, we're using the data that we have today to go back to address the question about why do we have a business cycle. So it'll go 1A, 2, 1B, and that's also the sequence on YouTube, in case you're trying to follow this on YouTube and are a bit confused with the order of things. So let's take a look now at the information we have from the National Income and Product Accounts today, which were released this morning at 5:30, and we can bring ourselves back up to speed. Oh, I might say before I get off that page that this lecture 1B, which is Data in the Business Cycle, I actually showed you the front of this, not this part here, but this part right here, I showed this to you in anticipation that this would be coming up, and I even showed you that, and I said we would end up with that discussion of the statistical measures of contributions to the business cycle. And so today I did have time to take the new data and rerun this whole thing again. And so this is the nominal GDP component continuous growth rates and standard deviations from 1960 to the present 2019 annual. Now, because waiting for this slowed us down some, this sub-lecture here will actually be posted as a video lecture over the weekend. It'll be about a 30-minute lecture based upon this slide set, all right? So you'll see it posted up sometime tomorrow or Saturday probably. And then that'll enable us to stay on track with everything else that we're doing. So that's where you're going to see that. Okay. So now let's get to the material at hand. It's here, so here it is. Okay, National Income and Product Accounts. Okay, now here's what we're going to use this information for. We're going to give you a statistical picture of the U.S. economy and show that this is an economy that is really driven by consumption, in contrast to smaller economies globally that may be driven by manufacturing and exports, for example, or even smaller economies that are driven by agricultural production. But this is a consumption-oriented economy. We import a lot more than we export in this economy, and you're probably aware of that because that's an issue that pops up sometimes in the presidential campaigns. Economic growth has been robust in my lifetime since 1946, but as we'll see in the second lecture, the one that I'm going to put online, it's been slower in recent years than it has been in earlier years. It's been averaging about 3.5%, but as we'll see, the growth rate in the last 20 or so of those years is a little bit more than half of that. We'll see that the bulk of national income is in wages and salaries, but wages and salaries are relatively stagnant and slipping in relative importance in the economy. Very important for purposes of business cycle discussions, we've become much more of a service economy and much less of a manufacturing and agricultural economy in terms of value produced, and that term is still continuing. Now, when I refer to a service, as we're going to see, we're talking about financial services like banking and insurance services, health. Generally, all health expenditures are classified as services in the GDP accounts. Legal activities of all kinds and their costs are classified as services. What you are buying when you pay your tuition at Harvey Mudd College is a service. It's classified there as well. Insurance and the like. And so basically a service economy is an economy that offers abstractions for the value rather than physical commodities for value. And so we're very much a service economy, which explains why this economy is so stable, as we're going to see. And then also in the United States, we make the point that we don't save very much at the personal level, although we save more than we used to. Now, these are the numbers that came out this morning, or at least the portion of the came out this morning, are the 2019 numbers. So this column right here is all the information that came out today. And although this is kind of hard to see, you can go back and look at this and disaggregate this a little bit more. And we're going to disaggregate it sort of systematically and say, what do all these things represent today? Let's nonetheless take a look at what it says. If you look at the 2019 column only, then we have a gross domestic product, which is a measure of the net national output of all of our goods and services in the United States, at $21.4 trillion in nominal terms, not adjusted for inflation. So $21.4 trillion of national output. Compared to 2005, which I'm kind of using as a benchmark here, that was the year just before the last significant recession. In that year, the economy put out $13 trillion. So nominal output, not adjusted for inflation, is about double what it was in 2005. The percentage growth rate of GDP was 4.1%. And you're saying to yourself, I thought I heard it was 2.1% on the news or something. That's the real growth rate of GDP that you heard the news about. The unadjusted for inflation growth rate, just the dollar value of GDP, increased last year by 4.1%. But the fourth quarter of 2019 growth rate in annual terms, adjusted for inflation, where you weed inflation out, is 2.1%, and that's probably what you heard on the news, if you heard the news. And then this is broken down into four major categories. Our personal consumption expenditures, and then that's further disaggregated. Gross private domestic investment, and then that's further disaggregated. Now, investment is not what the vernacular means. You may think of investment as buying stocks and bonds or something like that. Investment in the GDP account is typically purchases by businesses of productive goods and services, no matter what that is. And so fixed investment is a longer-term investment, and then you have structures, and so non-residential structures are like business offices and hotels and the like. Residential structures are your homes, so your homes fall under an investment category instead of a consumption category. My throat's going out, by the way, so I'll probably have to rely more and more on this mic. And then equipment is a range of smaller, less expensive things like computers and all this crap I have sitting up here and the like. And then intellectual property products are, of course, mostly IP protection and patent cash flows and things like that. And then a change in private inventories is something we'll explain a little bit later. It's premature to talk about that now. Then we represent our import-export sector, and as we said already, the United States exports a great deal more than it imports, and that's clear when you look at the data right here, going clear back to 2005 and up to 2019, right down, where is it? It's in, well, it's a big category right through here, and so you can see that we count exports as positive and imports as negative. It's not shown here as negative, it's just shown here as a value, but when we graph it, we show it as negative. Because exports add to our national output because we're producing it here and then selling it overseas, and imports subtract from our national output because we consume it here, but it's manufactured overseas. And so ultimately what matters is the spread between the two, or the difference between the two, and we'll look at that graphically here in a few minutes and not concern ourselves with it quite yet. And then finally, government purchases and gross investment of governments at the federal and state level come out to quite a bit. And I guess my head is chopping that off for the video. So on the video, take a look at this slide separately if you're looking at the video, or this very same slide is reproduced on the PDF as the very last slide and blown up a little bit if you're relying upon the video to look at this slide. This doesn't affect you. My head is chopping off the corner of the video on the slide for people watching the video. Okay, so the news then, we'll disaggregate this graphically or visually. It's more interesting than looking at all these numbers. So the news then pointed out that the real inflation-adjusted GDP growth from today's release has our economy growing at about 2.1% in the fourth quarter of 2019. And because there was a strong first quarter of growth, last January, February, and March, then the annualized growth rate, I think, is 2.6 or 2.7. I actually forgot what it was. And this is a little bit lower than was anticipated, but not a lot. And it was pretty much what I thought it was going to be. And it is a little bit lower than it has been in recent years, but it's certainly not a disaster or a problem or anything like that. It wasn't really a shocking number. It was more or less a number that was expected. So let's tear it down a little bit and take a look at it and see what it means when you disaggregate it and what it implies about the U.S. economy. Now, when we disaggregate it, then it starts getting interesting. This represents these major components of GDP organized visually so you can see their relative importance. So the bottom one, so again, we're talking about a total nominal output of $21 trillion. And a total of 14.6 trillion of that is simply in consumption alone. And then we'll disaggregate that in just a minute as well. So that's the sense in which we're a consumption economy. If you were to look at China, for example, which is becoming a consumption economy, this number, by the way, represents 68% of GDP. Their number is not even 50% of GDP, but it is rising. And then if you look at a small agricultural economy, then most of their size will be in net exports, and the consumption component will be relatively small. In our case, the net export component, as I said, is the difference between imports and exports, and that number was minus $632 billion, which means that we imported $600 billion more than we exported. And if you go back and take a look at this graph right here, going back, say, to 2013, it's an interesting question to ask whether that number has changed very much, the net number. And the answer is no, it hasn't. Despite all of the trade wars and despite all the tariffs and rolling back the tariffs, this number hasn't hardly budged at all. It grows slightly every year. And so you can see exports, for example, in 2019 were 2503, then 2510 the year before. So exports actually fell back a little because of the trade skirmishes. And then the year before that was 2356, 2220, 2266, 2371, 2273. So exports have been gradually growing independent of trade wars or no trade wars. But the imports have been doing exactly the same. They fell back a little bit because of the tariffs, but not very much. And the exports fell back a little bit because of the tariffs, but not very much. And so you can see in 2019, for example, on the imports, 3.13 trillion, the year before 3.14 trillion, so that's a slight decline, but it's not a significant decline. And then the year before that it was 2.9, then 2.7, 2.78, 2.8. So it was actually, we were actually doing better at this before we triggered off the trade war. It was actually coming down a little more before we triggered off the trade war than we have since, which means that all of this headline stuff about our spat with China, with the European Union, has not had hardly any impact at all upon reducing the size of the trade deficit. It's as though the trade skirmishes never happened, interestingly enough. We'll come back, of course, and formally look at that in our segment of this course on international trade, which is in about the 7th week or so. So the rest of it is back to our analysis, government spending and investment at being nearly exactly the same value. Now, when we talk here about government spending in the context of the national income and product accounts, there's a qualification that has to be made that is very, very important. When we talk about government spending in the context of the NIPA accounts, that is only exclusively government purchases of goods and services. It is not government outlays. The level of government outlays, especially at the federal government, is nearly 4 times the level of government purchases for goods and services. And when you say, well, what do you mean by purchases of goods and services? Well, Defense Department outlays, for example, for munitions and for salaries and for aircraft carriers and for tanks and the like. That's a purchase of a good or a service. Leases of property is a service, or either classified as a good or a service depending on what the lease is. But federal spending will be, as I say, 4 times the size of this category. And that's because about 75 cents of every dollar spent by the U.S. government, especially referring to the U.S. government part of it rather than state and local government, is for what are called transfer payments. And that's a cash payment to a party in the economy, and typically a person. All right? And you say, well, what's an example of that? And Social Security is an example of that. And Medicare is an example of that. And federal employee retirement plans is an example of that. So 75% of all the money spent by the federal government is simply a cash transfer to a private party from taxes collected by from another private party. And so the bottom line is, I already draw Social Security because it's financially optimal to do it while you're still working. I've been drawing Social Security for, I think, 4 years now. And I actually draw more than $4,000 a month in Social Security. So to the extent that you pay taxes, then you pay into the Social Security Trust Fund, and the Social Security Trust Fund takes your receipts and turns around and gives them to me because I'm entitled to them as Social Security benefits. That's referred to as a transfer payment and does not count in the national income and product accounts because it is not a direct demand for a good or service, and if it was counted, it would be double counted because I then take those receipts and spend the money. So it would be counted as the government spends the money, then it would be counted as I spend the money. So to eliminate the double counting, we only count when the federal government actually buys a good or a service and excludes Medicare, Social Security, welfare payments of all kinds, and federal employee and military retirement plans and the like. Okay, so always because when you see the numbers, you'll say, well, the federal budget's a lot bigger than the number we're looking at here. When we go back and take a look at the federal number there in this account, it comes to $1.4 trillion, and the federal government actually spends close to $10 trillion every year. And so you have to reconcile that, right? And they say they spend $8.6 trillion on transfer payments, and they only spend $1.4 trillion on buying things, and that's right. That's the way it works out, as we're going to see a little bit later. So right now we just acknowledge that we're only counting their purchases of goods and services. Okay? Now let's break it down even further. You can see how important consumption is. Now, as we break it down further, though, you can see that it's still kind of lopsided because the consumption component is dominated by what I identified as services, which is unique to this economy. The European economies kind of look like this and are growing in this direction. And some of the more mature Asian economies like Japan and South Korea and even now China are seeing their services component grow, but it's still not as important as services is in relative terms in the United States. So services constitute $10 trillion of the $21 trillion. Now again, services are our outlays for abstractions, like your purchase of tuition or you're using tuition or paying tuition is a service. Bank services, flight and train, taxi, Uber, those are all counted as services and the like. Financial services, insurance services, and the like. So we are a service economy. Almost half of our GDP, about 45% of it, is dedicated to service outlays alone. Now, this will be important later on because when we evaluate statistically what's volatile and what is not volatile, the category of GDP that is the least volatile of all of them is the service category, which explains why our economy is a very stable economy compared to many others. Services is a remarkably stable category in the GDP accounts. Then we get down to non-durable goods, and non-durable goods tend to consist of, as the name implies, the durable goods, the goods that we consume that are physical but don't last, like food. Clothing is classified as non-durable, even though, of course, a shirt can endure for 20 years if you really take good care of it. It's nonetheless, because it's a less expensive item, it's classified as non-durable. And durable goods is what will last, typically classified as big ticket items, as they call them, such as automobile, furniture, and the sort of things that would be naturally classified as a durable good. And in the gray areas where you can say something like a pair of shoes might last, what is it? If it's in the gray area, it's always going to be classified as a non-durable good. The durable goods are those things that are obviously durable goods, such as I say, furniture and automobiles and large ticket items. Sometimes the relative cost of the item has more of an impact upon its classification than how long it's anticipated it will last, for example. So the non-durable good category is considerably smaller than services, but a great deal more than durable. The durable goods categories, as I say, tend to be large ticket items that are debt financed, and instinct or intuition would tell you, yeah, that's a durable good, such as automobiles and furniture. Now, it turns out that the durable goods category in consumption is the smallest category, but is by far the most volatile category. And so, again, that to some extent explains why we do not have a volatile economy overall, because this one major volatile category of consumer spending has the lowest weight of all classes of consumer spending, as we'll see a little bit later on. Now, what we think of as investment, and again, investment is not what it means in the vernacular. Investment here means the purchase typically of a business, but not always, of a productive piece of good or equipment, including real estate, but also including computers, trucks, rolling stock, you name it, that sort of thing. And that's divided into equipment and software, residential construction, which is your purchases or your parents' purchases of homes. So there's kind of a consumer category that is in the investment class, and that's residential construction. Non-residential construction are business buildings and the like. Intellectual property products are abstractions for the largest part that are more or less the services equivalent in the business category. There are, of course, sizable payment flows for patent rights and the like, and that shows up as income in the national income accounts, of course, and it amounts to a lot. And then change in business inventories is simply something that has to be there so the account will reconcile. And that is, if you think about an automobile dealer having an inventory of automobiles, if during the calendar year that went up in value, that makes a positive contribution to this change in business inventories category of the NIPA accounts. It has to be there so the account will reconcile because the items in inventory were produced but have not yet been sold. So if you didn't have inventory adjustments in the NIPA accounts, then supply and demand would not balance. And so it's a relatively unimportant category, but it's there to make sure that everything balances out. Now, as we say here, you can plainly see that our exports were $2.5 trillion overseas, and our imports, which count as negative in the NIPA accounts, when they're all summed up to total GDP, is minus 3.1 trillion. And that spread, as I say, is consistent and has not changed during the so-called trade wars that we've been either fighting or not fighting, depending on how you look at it. And then, of course, again, we have state and local government purchases and federal government purchases, which again do not include transfer payments, such as Social Security and welfare. So as these things fluctuate, then you get a business cycle out of the economy. So to understand why the business cycle behaves as it does, you often disaggregate your GDP accounts to see what's growing, what's not growing, what's cyclical, what's not cyclical, and so forth. And so for the next couple of lectures, we'll do that. And what we find will be relatively revealing. Now, here's some definitions about some of these. The real GDP adjusts monetary GDP by removing inflation. And the technique that they use to remove inflation is called a chain type price index. I used to try to teach it, but it's so complicated that students would just get confused. And so these days I say they do have a method used to adjust GDP growth for inflation called the chain type index. And if you're curious about how it works, this lecture ends with a footnote to where you can go read about how it works, and we'll be content with that. And you know, of course, that it is adjusted for inflation because it wouldn't make much sense if you didn't adjust it for inflation. You don't really know how an economy is doing when you look at the nominal GDP growth rate without taking inflation into account. The Venezuelan economy is growing at a torrid rate of about 500 or 600% per year. That's pretty impressive, isn't it? No, it's not very impressive at all because the inflation rate is 100% above the actual nominal growth rate. Again, services include financial, health, recreational services. I left that out. You go to a basketball or baseball game or go down to the new stadium they're building for the Los Angeles Rams and pay for that high-priced ticket, then that's going to be a services category. For transportation like Uber, Lyft, and the like. For housing, and of course your very valuable education. Consumer durables are generally big-ticket items like autos and furniture, often purchased with credit, which is why they're so cyclical. Then residential investment reflects the value of a new home, construction, and this is therefore not included in consumption because it's an investment type outlay. And then changes in business inventories, albeit small, may be positive or negative, and are sometimes early indicators of recession. When they grow but deep in recession, they can turn strongly negative. So what I'm just saying here is sometimes economists look at that change in business inventories to see the sign, and if the sign is strongly positive, like a big positive number, ask yourself logically, is that evidence that you're going into a recession, or is that evidence that the economy is strong? It is actually contributing, if it's a big positive number, positively to the GDP number, and it's actually making the GDP growth rate high because it's just another thing that contributes to the sum total of what positive GDP amounts to. But if it's a change in business inventories that is the large number, is that evidence of potentially a slowing economy or an expanding economy? Which do you think it is? It's a logical question. Well, if you have a logical mind, Spock-like, then you'll be saying that's evidence of a slowing economy because that means that inventories are not being sold. No business would intentionally run up their inventory. So if, in other words, you're looking at automobile inventories, it means that cars are on the lot and not being sold, obviously. And if you're looking at a computing equipment inventory, it means the shelves are full of stuff that isn't being sold. Of course, if it's retail stores and the like, then again, buildup of inventory can be a very negative thing. So this would indicate right now that we don't have anything to worry about with the numbers we saw in this GDP account, because even though that's positive, it's not really large. And then again, we've already said this a couple of times to make sure you don't forget, because when you see the numbers on government outlays, it won't be anywhere near this number that we're looking at here. It'll be way, way above it. Government spending in both categories, meaning by both state and local and federal as the two categories, do not include transfer payments like Social Security. Now, when you break this down, sometimes professional economists trying to figure out whether we're approaching a turn in the business cycle will disaggregate the NIPA accounts even further to see if there's any indicator that we're turning the corner. Because remember, when we talked about the pathology of the business cycle, we pointed out that when you reach the peak, maybe inventories are being drawn down and there's some inflationary pressures. Also, though, one early indicator that the economy can be turning, as I just said a minute ago, is inventories, but specifically real estate and auto sales and auto inventories, for example. Now, this quarterly data, most of the data we're looking at today is annual data. This quarterly data shows, in the case of the orange bar, annualized quarterly growth rates of durable goods in the orange bar, and the green represents residential construction. And so this goes from 2005 up until the present, until just a couple of weeks ago. And you can see that there was a big downturn, especially in the green, through that period 2006, 2007, and 2008. And it's not an insignificant downturn. We're looking at annualized growth rates of quarterly data that exceed, in a couple of cases, 30%. That's a significant downturn. And you can also see right when the real estate downturn was at its worst, auto sales were doing almost as badly, or doing poorly, because you could see that one quarter, where the downturn in the automobile sales, it's not automobiles only, it's durable goods, but auto sales make up the bulk of durable goods. You can see that was down in excess of 25%. And so but they're not perfectly correlated. It's clear that the real estate turned down long before the durable goods did. You can see that in these years right here that run right through here. Auto sales through here are kind of positive, but this is really negative. But as things drag on, then auto sales join in and they come down just as well. And then this is still volatile going out, but finally it begins to recover. But clearly auto sales recover coming out of this. And so this was an early indicator that this economy was in pretty serious trouble, because we're looking at ultimately the effect of the mortgage meltdown and the impact upon the economy in those years. And the economy right through here, by the way, was still growing. It was growing about the same pace that it's growing right now. 2006 was a growth year in this economy. But anybody looking at the disaggregated data would say, this may not be growing very much longer, because this key leading indicator category has turned way, way down, having negative growth rates each quarter at an annualized rate of in excess of 10%. And then the rest of the economy followed it down. I can remember when that was happening, we was talking about it actually in this class. It wasn't clear to anyone looking at the GDP accounts in the aggregate that we were in a recession until about mid-2008. By then it was really clear we were in a recession. But I remember opening the lectures in 2008, in the spring 2008, and the reason I remember is because of the image I used. We were debating about whether the real estate downturn, which we were aware of, at least in this class, would drag the rest of the economy and the global economy down with it, or it would be contained. That was the issue that we were discussing. Will this be contained or will it spread? Well, the answer ultimately turned out to be it will spread. and affect everything, of course, because the economy really went to hell after 2007. But there was some discussion that it could be contained within real estate and not spread to the rest of the economy in 2008. And so I opened that lecture with an animated picture of the phoenix rising from the ashes, right? I said, what's going to happen here? Is this going to be this or is this going to be that? And the bad side shows the phoenix rising from the ashes and setting everything on fire. And so I don't think the students remembered anything about the lecture, but they do remember that image because students tell me still, wow, that was a really cool lecture. You set everything on fire. And I said, do you remember what that was about? No, I don't remember actually what it was about, but it was a really cool lecture. So I remember it quite well too. It took me a while to choose that totem. So right through here, this was really unclear as to whether it would be contained or would spread. And then after 2008, there was no doubt about it. After about March or April 2008, it was a bad way. But the market really didn't turn down until about then, and the market kept falling until summer of 2009. And there was a big decline in the stock market during that time. So then you could also kind of tell when it was getting better right through here. The real estate sales were still kind of crazy, but durable goods sales spiked back up again and were very positive. And you don't see services ever go outside of the range of in quarterly annualized growth rates of 4% ever. And here we're looking at 30 and 40% swings, or absolute swings actually of 50%, minus 30 to plus 20. And so you begin to recognize you're seeing where the volatility is found in this economy. And it's in categories like this. Now I have this in here, DWBH means don't worry, be happy, because anytime you look at a textbook that discusses the national income and product accounts, it says, first of all, let's take a look at national production. And that's what we're looking at when we refer to gross national product, right? We're looking at our production of goods and services, and we add all of those up. And that's what we've done up to this point. According to economic theory, though, in a closed economy at least, that should more or less match the generation of income. And this notion that they would be nearly an identity goes way back. The theoretical notion they should be nearly identity goes way back to the writings of a French economist whose name was Say, and he wrote up this proposition that today is referred to as Say's law. And it is one of the reasons why people argue that markets are undurable, where he effectively argued, he didn't argue it in such simple terms as I'm using here, but he effectively argued that supply creates its own demand, which is to say the very act of production generates income that makes it possible for whatever was produced to be purchased. And this was part of an argument that was being proposed by the classical economists that explained why markets that do not have much government interference can endure for a long period of time. Because they kind of have this automatic mechanism as production takes place to generate the very income that can be used to buy what was produced. And that's always been referred to as Say's law. Now, that breaks down a little bit when you become an international economy because there's imbalances when you become an international economy. It also breaks down when you add time lags to it. And at the micro level, you realize it may be true that production generates income, but if you're producing something that absolutely nobody wants, then people aren't going to buy it, right? And so there's all those qualifications to Say's law, but Say's law is generally regarded as axiomatic so long as you keep it fairly general. And so it's for that reason that the national income and product accounts, once they present it to you in the form of national product, then they present the same thing to you in the form of national income. They say, let's go back and take a look at this again, but look at it in terms of the income that was generated by this production of goods and services and see how that breaks down. Now, the reason we have this here is because they don't reconcile in the national income accounts unless you do these things. And this is not a slide where I expect you to understand what these things are or why they actually reconcile the account, because that would be asking. It's pointless to figure out, what all of this is saying It's just a slide to indicate to you that statistically these accounts are reconciled. And if you and they're reconciled by taking into account, for example, the leakage that's caused by foreign trade. And so this distinction between gross national product, net national product, and the appreciation of capital, the depreciation of capital, all of that is necessary to make these numbers add up. And so you don't need to know, how that's true. You just need to kind of remember that that's true.
So when we calculate GDP, if let's say somebody invests in building a house, is it the money put into building the house, or the money or is it only counted when somebody buys the house?
Well, if it depends on which side of the account you're on. Now, if we're on the national income account, it's when you get paid that it gets counted, all right? Because that's the major category of wages. When the house is sold is when it counts on the GDP, which is why the business inventory the business inventory classification has to be used, right? Because so what do they count? They count sales. You say, well, how can sales be a measure of output if you're just counting sales and not output? You say, well, we assume that whatever was bought was produced. And they say, well, what if it was produced and not sold? Well, then there would be this irreconcilable difference. So we say, well, let's take out what wasn't sold. That's the change in business inventories. So then you could say with a reasonable confidence that what was sold, adjusted for a change in inventories, is what was produced. So the numbers are at the point of sales for the largest part for the GDP accounts. Okay, so when we look at national income, of course, it paints a different picture. It's not inherently revealing, except that you can see what matters on the national income is how it's changing over the years, not what it is. I'm going to drink some water here. My throat's slowly giving out. We'll see if I can go another 20 minutes. Speaking of containment or explosion, so is the coronavirus going to be contained? It's a rather interesting question, isn't it? Especially given the draconian measures used by the government of China to try to contain it. Completely unprecedented in the history of all of humanity, except for one prior incident, that incident being the Black Plague. I'm not kidding, the methods used during the height of the Black Plague was exactly what everybody stay in their home. Nobody move. Nobody go anywhere. And it's kind of also an interesting question about whether it's as serious. It seems to be, because the mortality rate is at about 2.5%. That's pretty high. That's a lot worse than the flu, obviously. So, but you don't know if that's really the mortality rate, because the number of people who die, easy to count, they're dead. The number of people who actually have the virus, maybe not so easy to count because they haven't come in to be checked or anything like that. So it's hard to say that the mortality rate is actually 2.5%. Based upon the official numbers reported, it is, but that doesn't mean that's what it actually is. So, but watching the nations, and especially China, struggle to contain it is an interesting artifact. It's having a negative impact upon the stock market, kind of, I'm not even sure why that's true. I don't think the stock market is much impacted by any of this. Anyway, when we take a look at national income, as you might guess, most of this is in wage and salary compensation. But if you want to begin to understand the role of governments in the modern economy, I was just explaining a while ago what a transfer payment is. This is a staggering number. 18% of all income earned in the United States is a transfer payment from a government. And that's a very, very large number compared to what it was in 1960 when it was 5%. So we're becoming a government of transfer payments. An economy of transfer payments to some extent. All of these categories are larger than they used to be, as we're about to see here in a minute. This is dividend income, and this is interest income. Let's see, interest income, which is which? This is non-corporate business income, and this is rental income, and these are wages. And so when we compare this to 1981, although this is kind of hard to read, The interior represents this distribution in 1981 there, and then the exterior represents 2019. So you can see that this is disposable income, personal income. And so we can see that the wage and salary compensation has shrunk some, right? But we can see that the government transfer benefits right through here has really increased a lot. We can see that dividend income from corporations has really increased a lot. And if you study the stock market, you know that's true, because dividend income is way up compared to what it used to be. And we see that interest income is shrinking a lot. And the degree to which it's shrinking is almost shocking. This is due, of course, to the fact that interest rates are close to zero on everything. And so you may remember that I said that this is sort of forcing middle-class investors, especially investing for your retirement, your parents especially, and your grandparents maybe to some extent, to move those investments away from fixed income investments like bonds and notes and bills that pay interest into the stock market. And it is that effect that is being reflected in the precipitous decline in the interest income as a percent of personal income now compared to 1981. There's twofold effect there. One, the rate earned on such investments is lower, and because that's true, we rely upon fewer such investments to maintain our retirement accounts. And this is regarded as substantially dangerous by economists, because these categories of investments, like long-term treasury bonds, are extremely stable and very, very suitable for long-term investment accounts, whereas investing in Tesla, not so much. And we know what Tesla's doing really well right now, but Tesla's got a pretty wild history of swinging up and down $200 per share, so as we're going to continue to see, I'm sure. So the economy structure is changing a little bit, and it is more a riskier economy, except this is very stabilizing, but it simply means that your generation is basically being hosed, as we're going to see, because the tax burden of this now is increasingly falling upon you, and the benefit from it is going to me, because as I just said, for example, I'm pulling down Social Security while being fully employed, and it's your generation and a little bit older than you that's paying for it, and that spread actually exacerbates during your lifetime. And as we'll see much later in the course, that same program that you're paying into, presumably for your own benefit, although the cash is literally going directly to me. There is no fund or anything that it goes into. You pay it in, it's sent back out to me. The trust fund that represents the spread for that is forecast to go bankrupt or to zero in the year 2030. About 15 years before, or 20 years or so before you retire. So we'll talk about that later on. That for you will be a very depressing lecture. For me, it's kind of an uplifting lecture because it means that I can go on golf tournaments and all kinds of stuff, and you have to pay for it. I might even fly first class at your expense. Not my fault. I didn't write the law. Students sometimes see me in the airplane. I'm always in first class. Say, how the hell do you afford first class? Well, you're paying for it some way or the other, or your outrageous tuition charges. You're also paying into Social Security, so I'm grabbing it from that. And then I'm getting all these outrageous tax deductions because I own a house. I don't pay any taxes myself. So you're paying for my services that I get for the government. It's not fair. Now, this is it really isn't fair, actually. So this is more along the lines, we'll keep coming back to this subject because we're going to start talking a little bit more about the presidential election coming up because it's a big deal, right, to say the least. This is more along the lines, when you take a look at the GDP numbers, this data is typically not all that current because it's census data. Census data often has a very long lag. So this data is only up until 2012. And this was only published 2 years ago. But again, this is showing that median household income is pretty much stalled out. And so you can even see that for whites right through here, you're not really getting any growth, and just below this is all races. So you can see kind of that household income was picking up. This is in real terms, adjusted for inflation. Then it peaked, right here in 1998. It's never gone back to what it was in 1998, median household income in real terms. And then, of course, it varies a little bit for different races, but it's pretty much the same story for everyone. So not only is there the issue surfacing during the with regard to the upcoming election because of the disproportionate allocation of deltas in wealth and income, but there's also underlying that the fact that for most classes, except for those in the top, income's not growing really, as measured, for example, by median income here. It's interesting to watch these developments. It appears that Bernie Sanders, of all people, is pulling ahead in the race, interestingly enough. I'm not sure why that's true, but Biden's slipping back, Warren's slipping back, and he's taking up the gap. And it looks like he's likely to win Iowa, and of course he'll almost certainly win Vermont. So he's actually rising in the polls even in California. And that's going to make for a very interesting presidential election if it's Bernie Sanders versus Donald Trump. I have to wonder if you're responsible for this, because I guess from what I read, people your age tend to prefer Sanders over most others. That's his big support base is people under age 30, and also people under age 25 or so. Maybe you're getting pissed off about all this stuff. If you think Bernie Sanders is going to fix it for you, though, you got another thing coming, in my opinion. We'll get to call you Boomer. You can say, "Okay, Boomer." I get to say derogatory things about you in about 10 years. Anyway, so this is going to play a role in the presidential election as well, I kind of think. Okay, now what we care about, though, here is to some extent how it's changing what the growth rates are. The numbers by themselves in the aggregate don't mean very much. So these are the numbers for all of 2019. I didn't take the average of this, so that's why I didn't remember what the average is for the year. The one that was just released today was 2.1%, which matched the third quarter, and was just a little above the second quarter, but well below the January quarter. So whatever those average out to is what the GDP growth rate was in real terms for all of 2019. But when you take a look at the annual data, which includes these 2019 numbers, this is a zero reference line. Here we can start to see where the business cycle surfaces, or where at least we've had recessions. Because remember, we're using the crude definition of a recession for a lot of this discussion. And that's when the real GDP growth rate turns negative for 2 consecutive quarters. And so this is annual data, so obviously if it turned negative for the whole year, it's likely to have been negative for 2 consecutive quarters. So this was the very bad downturn that I was talking about, being led by first real estate and then consumer durable goods, right? But this is the, right through here is the dot-com crash. See, actually, it didn't turn negative for the whole year. So as traumatic as that was for the stock market, it didn't really impact the economy as a whole very much. It was a recession because for 2 of the quarters it actually was strongly negative, but it was strongly positive at the beginning and the end. And so it doesn't even show up in the annual data as a recession. Going back a little bit, though, this is the period right after the inflationary episode, and this one right there, which was a pretty serious recession, was actually the policy response to the inflation. Paul Volcker, the then chair of the Federal Reserve Board of Governors, basically smashed the U.S. economy with very high interest rates for the purpose of squeezing inflation out of the economy. It brought the economy to its knees. We had a very bad recession, but it killed the inflation. So you can see that it has been volatile. You can see that it's not unusual up until your time span. You were born right around through here, right? So we don't see 4%, 5%, 6% growth rates anymore. So the economy now, although it's in the longest recovery on record, is recovering at a relatively slow pace for that. That's better, certainly, than nothing, to be sure. 2% is okay, it's in real terms, I guess. But it does mean that real incomes for the American working class, because of the maldistribution of wealth in that 2%, is not growing. So most of that 2% is being captured by upper income groups, in particular, the 10%, the 1%, and all of that. Here, though, in the past, man, we could see torrid. Look at this. This is above 4% here for a long time. Once again, considerably higher than 4%. Sometimes in these lectures, by the way, I make these calculations in arithmetic, and I get it wrong. I was looking at the last lecture I gave you, and I was talking about the mortgage rate being above 10%, and I subtracted 90 from 77 and said it was 23 years. It's only 13 years. So if you caught that, it was 13 years, not 23 years, in my mental calculation. So it's been strong and fairly stable, but stable at a fairly low level. Now we're going to come back and look in much greater detail at that in the lecture that I'm posting on video. Now, when we take a look at the changes in this economy over, say, my lifetime, or your parents' lifetime, my lifetime is 46 on, this is 1960 on, this reflects the fact that we have become, in this period of time, a service economy. Because this is consumption and this is a service component which has grown largely at the expense of consumer non-durable goods. Consumer durable goods, which, remember, automobiles and the like, have stayed relatively steady all during this period of time and relatively low at below 10%. But this is where we have shifted gradually our production and our consumption slowly away from manufacturing of consumer non-durable goods and agricultural products, of course, to a service economy: health, financial, insurance, education, government, communication, less of a goods economy, manufacturing, textiles, food, and so forth. This will be the reason why this economy has become so stable, because when we get to the portion of the course where, in the video that I'm going to post online, we take a look at how volatile these individual components are, this category, the service category, will be the most stable of the group, and this category is the least stable of the group. And so the most stable of the group has grown from relative importance of 30% of GDP, below that 28%, up to about 46% of GDP. And with that has come the slow-growing, stable economy. Most other maturing nations are following this path. China's starting to move in the direction of consumption, and their consumption is starting to move in the direction of services. And in the European Union, the same phenomenon is taking place. It's just kind of the nature of modern technology and what it provides.
What is, I guess it's sort of hard for me to picture an economy that's less dependent on services. So does that mean people go to restaurants less, or they go get less Ubers?
Well, they're poor typically, because a lot of the services we spend are what others would regard as luxury expenditures. Mm-hmm. Part of this, by the way, is, you say go on a Saturday to a movie and you spend $80 and there's just two of you. That's really easy to do. I do it all the time, right? If you don't take your own popcorn, which is hard to do, then you pay $5 for a candy and whatever. And so the next thing you know, you spend $65 to watch Superman beat up the Hulk or whatever. And they don't do that overseas because they can't afford that. So that's part of it. But a lot of this is the price effect, as it says right here. This doesn't mean that in terms of the sheer weight, one might say, of what we buy, that is trending as much. It's that the cost of producing these consumer non-durable goods is plunging because of you, because of your contribution to the technology of manufacturing them, right? So you say, well, what if you disaggregated a category in here called toys? Say, what's happened to toy sales and all of this? And it would show that toys have fallen in value, just like in the United States especially, clothing is falling in value, not because we consume fewer toys, we probably consume more toys than ever, but because the price of manufacturing toys has plunged. So you can buy a toy for a kid for $2 that used to cost $12 because it used to be made of metal and now it's made of plastic. Same thing true with clothing. You know, the clothing is so cheap as to almost be free, right? You can buy a pair of pants on Amazon for $18 and you can buy 6 of them and send 5 back, and all that. And so the markup on those also is 80%. Those pants that you're paying only $18 for only cost $3 to make and the like. And so that's the consequence of productive technology. So it lowers the value of this in the GDP accounts because all that matters to the GDP accounts is how much money did we spend on it. So services don't tend to be like that. You don't get productivity gains in services in the same way you do in manufactured goods. Although you do get them, and it's usually computing that gives it. The big revolution, of course, it will lower service component costs for services, as will be robotics, of course. If you do develop the Uber that drives itself, then that's more or less the same as developing a technology for manufacturing textiles that cuts the price of textiles down to a fraction of what it used to be. We've already seen this, for example, in banking. Banking services are far less expensive than they used to be because of RAID 0 and RAID 1 and RAID 5 and RAID 6, because those technologies allowed the development of the ATM machine. Basically, they couldn't develop the ATM machine until they were sure that transactions could be perfectly cloned cheaply. So the development of RAID technology made that possible because obviously there's no people involved. So the only record you have is the record that the machine keeps. So you have to have a dual record created of everything that's done at an absolute minimum. So just as soon as RAID technology was well developed, then I even remember the name of the company that did it, but I don't remember. I mean, I know the name of the company that did it written down somewhere, but I don't remember it. Then ATM machine took off and exploded in popularity, which eliminated the need to have bank tellers. So therefore, banking services per se declined to a tiny fraction of what they are now. In fact, there's kind of an interesting, I'll say a little bit more about that to kind of make the point, because this comes up in the productivity discussion that's not far behind us now. This is an example of exactly what we're talking about, right? When I was discharged from the U.S. Air Force, it was April 12, 1970, and I wanted to buy a car, and I bought a 1960 Ford Falcon that was 10 years old. And I didn't have any money, and so didn't have much money. And so I had to take out a $300 loan to buy this Falcon, and I got it at a bank loan. Well, I remember doing that. You had to fill out this sheath of paperwork that today would be equivalent to buying a house, right? Just one thing after the other, this big stack of paperwork. And so I filled all these papers out and all this and all that. Then you submit it to a loan officer at a bank. Back in those days, they would take this loan application, which was physical, stapled together, 12 pages or something like that. They'd stick it in a bin. Then this lending committee would receive all of these periodically every 2 or 3 days, right? They go through them, read them, pass judgment, approve or disapprove the loan. Then they would notify the lending officer you were working with that the loan was approved. Then you go back in, you signed off more paperwork, and then finally, after about a week or 10 days, they gave you your loan. You could buy the car. So I still remember this process. And so, of course, it's very time-consuming, but that's a service. That's an example of a service, right? Well, then a man came along named Bob Isaacs, whose grandson went to college here, whose name was also Bob Isaacs, in the 1980s, and he developed what is called the Fair-Isaacs credit score. And that was a way of looking at the purchasing behavior and loan payment behavior of bank customers from an actuarial point of view and giving them a credit rating based upon that record. And that revolutionized the very type of lending I'm talking about, because Isaac argued in these papers that he wrote that there's no need for a bank lending committee to review all these loans if a person has a credit score, say, above 720 on a scale that goes from, say, 0 to 800, that you should just automatically grant the loans with no qualifications under to this and that. And so banks were a bit skeptical, and then they figured out this has to be true, and so they eliminated all of this paperwork. And then they went one step further with the Fair Isaacs credit score, which was, again, kind of an innovation in the area of finance rather than what you're used to, like robotics. And they said, well, if that's true, why can't we try to sell people the credit instead of passively waiting for them to come in? And the modern day credit card was invented. So I send you something in the mail saying, here, if you want to borrow $3,000, just go use this card. And that was, again, based upon the Fair Isaacs credit score, see? So that cut down the cost of loan transactions to a fraction of what it had been, and is the kind of phenomenon we're talking about here. And then, of course, the use of credit thereafter exploded in the U.S. economy because it went from a passive industry to a very aggressive marketing industry once the credit score came along. But that's an example of how innovation completely changes the picture on this stuff. And it also, of course, lowers effectively the cost of a loan. And it raises the profitability of the bank, so everybody wins out. Yeah.
So how can we see that transition from people using privately owned monetary assets to using credit? Is that reflected in the GDP?
It's mostly, your credit score even today, it hasn't changed much. It's based simply upon your history of paying your bills.
But is there a way that we can take the idea of where people start spending more of their money based off of credit than some income that they've already made? Is that modeled anywhere in the GDP?
No, I'm not talking about how it affects GDP. I mean, the implication here is that it expands in a real sense the service without showing a rise in its monetary value. Okay. In fact, it would have the effect very possibly of lowering GDP, except, of course, because people get fired. All these loan officers get fired, except that because now all this credit's available, we start spending it, and so it has a substantially expansive effect upon the economy because we all start using this credit. So net after everything, the economy expands. But the point is that the nature of what is being counted here now, it changes over time, is strongly impacted by the technology of it. And so it's your contribution to this revolution is going to be in such things as transportation. I mean, you know perfectly well that there's a lot that's going to happen in personal transportation, right, because of robotics and self-driving cars and stuff. Way beyond that, we're not even thinking about right now. You know that's in the cards because students or graduate programs right now that were here 2 or 3 years ago that are way down the line on, where this understanding on where this stuff is going and working on it. It's a very lucrative area to be employed these days. To continue on with this, when we look at personal savings as a percent of disposable income, I used to make this argument that our savings is going down, 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 down. But after the last recession, it's actually climbing up and has been reversing this long-term trend. So it maybe not isn't so appropriate anymore to say that we don't save much. It was really the case where the situation was looking dire because of the fact that we save so little. But this is also is more complicated than is suggested by this slide. This is reflected by the fact that we do save a lot, but in the GDP account, savings is counted as net rather than gross savings. And what I mean by that is if you save in your retirement account, for example, $200 per month, that's gross savings. But if in the same month you use your credit card and run the balance up by $180, your net savings is $20, right? because you've increased your liability by 180, you've increased your savings by 200. And so the reason this was going down so much is because on gross we were saving a lot because of the type of retirement plans we have, which counts as savings, but we were using more and more in credit, and as a consequence it was netting out to lower growth rates. And so therefore we have to say this about all of this. Personal savings is equal to gross personal savings less new consumer debt. And so one of the reasons why the savings rate for decades literally was declining was because of the fact that the use of consumer debt was putting the net number way down. Usually a decline in the savings rate represents an increase in the use of debt rather than a decision to reduce savings. It's also important, this becomes really important for certain things later. This is why I stress that this will likely be on the exam in some way or the other. There was a time in 2000, not this, but the next thing, the personal savings turned negative in 2005. That's not the issue, but this is what's important. We have high levels of gross savings because we are non-discretionary savers in the United States. We have institutional savings. Institutional saving is where you're forced to save or highly encouraged to save through your 401k plan or pension plan. So you don't choose to save, it's just part of your employment contract, and that's called non-discretionary savings. We have a fairly low level of discretionary savings in the United States, and that's where you choose to save by simply adding a certain amount of money to a savings account or through the purchase of financial assets. When you buy stocks and bonds, in the context of this, that's an act of savings when you buy a stock or a bond. So we have high levels of business savings in the United States, and we have enormous levels of global savings overseas. So when you talk about savings, you have to be careful about who you're talking about. When you're talking about Apple, Apple saves a staggering amount of money, and a lot of that is overseas, especially in Ireland, because of tax considerations. So these large corporations like Apple will have huge levels of cash and have very high levels of debt at the same time because there's tax advantages for using that combination. So you'll take a look at Apple and you say, wow, they have a lot of debt at Apple. Then you look at their cash position and you say, wow, they even have more cash than they have debt. And that's characteristic of a large technology company. There's tax considerations that explain that behavior. So here's some conclusions we can make about this, and then we'll break off. This is a consumption-driven economy, if there ever was one, because as you saw, services alone counts for almost 50% of GDP, consumption as a whole about 68%. We still import a lot more than we export, and that's because we're a consumption economy, because when we consume things made overseas, obviously. Economic growth has been robust in my lifetime, about 3.5%. Well, I should say fairly strong in 2019. Didn't get that fixed. But it's clipping along at about half its long-term average in recent years. We'll go back and look at that data in the future again. And the bulk of national income is in wages and salaries, and those are stagnant right now, especially when measured on a per-family basis or measured by median income. We have become much more of a service economy and less of a manufacturing and agricultural economy, and that has implications for the stability of the economy. We'll come back to that again. And we don't save all that much at a personal level, although that's certainly less true than it was up until 2005. Now, if for some reason, this is never going to be voluntarily true of you, but if for some reason you need to go look at the national income and product accounts because you're writing a paper because you're an econ major or something like that, then this additional information says a lot more about the business cycle, about a primer on GDP, and more about these things, in greater detail, and then how the economy is measured. I did have you listen to an audio, right, about how secret this data is. We've come to that by now in the class, haven't we? Yeah. And so that's really true, right? They really try to keep this stuff secret. So over the weekend, you'll get an email from me saying I've posted up the video, which will be about a 25 to 30 minute video that goes back to evaluating these questions from a purely statistical point of view. And it will confirm in statistics what we've already said. So have a good weekend. We'll see you on Tuesday.